Right. We're initiating today's deep dive into the Bitcoin market intelligence. And the mission for this session is a very clinical, direct assessment of the structural data over the last 24 hours.
Right. Yeah.
Because as a daily listener, you are already well up to speed on the broader macroeconomic backdrop that brought us to this point.
Exactly. You know the baseline.
Yeah. So our objective today is to parse the massive structural reversal that occurred between March 5 and today, March 6, 2026. What has changed is, it's stark. The institutional buoyancy and the massive ETF inflows we tracked yesterday have violently fractured into tactical de-risking today.
It's a total paradigm shift.
It really is.
Yeah.
In just 24 hours, the market has been hit by an unprecedented non-farm payroll shock, a complete reversal in institutional capital flows, and a highly dangerous geopolitical expansion in the South Caucasus. We are going to maintain a strict clinical focus on these developments, dissecting the facts for you to understand the immediate market microstructure.
Exactly. To accurately contextualize the severity of this reversal, we need to constantly compare the baseline of where we stood yesterday against the empirical data hitting our desks today.
Right.
The velocity of these shifts really requires precision. We are looking at a market that is simultaneously processing domestic economic contraction, international kinetic expansion, and systemic regulatory friction.
Yeah, so let's start with the immediate market microstructure and the capital flows, because the shift here is jarring. Going into yesterday, it looked like relatively smooth sailing. Bitcoin was actively testing the $74,000 threshold. And that momentum was driven by a massive 3-day streak of $1.145 billion in ETF inflows.
Right.
And that streak was completely dominated by BlackRock's IBIT vehicle.
That was the established baseline. But waking up today, the map has completely changed. We are looking at a definitive technical and capital retreat. Bitcoin has contracted by roughly 2.84%, dropping into the $70,658 to $71,061 range.
But we need to unpack the mechanics of that specific range.
We do, because it brings us right to the Adam and Eve double bottom pattern that has defined this recent recovery. The critical neckline for the specific technical structure sits exactly at the $70,000 mark.
So right on the edge.
Right on the edge. If the asset fails to maintain daily closes above this pivot, the current bullish structure is mathematically invalidated. Order book data confirms that a decisive break below $70,000 opens up a nasty deviation toward historical demand zones near $66,000.
Wow.
And this downward threat is severely exacerbated by a dense cluster of leveraged long liquidations sitting precariously at the $70,500 level.
So we have a highly fragile technical floor, and the primary mechanical driver of this price contraction is a complete 180 in institutional capital flows. The inflow streak we tracked has officially snapped.
Hard.
Yeah, the data today shows $227.9 million in aggregate net outflows on March 5. But here is the data point that really stands out. BlackRock's IBIT, which has been this absolute monolithic vacuum for institutional capital.
It bled $89 million in a single session.
Exactly. $89 million.
For you, the listener, understanding the structural so what of this data is crucial. This ETF hemorrhage does not indicate a fundamental long-term abandonment of the asset class by traditional finance.
Right, they aren't just walking away.
No, rather, it represents an acute, tactical de-risking maneuver ahead of high-volatility macroeconomic data.
How do we know for sure it's tactical and not a broader exit?
We can confirm it by observing the broader capital rotation. Over the last 3 months, physical gold and gold-related instruments have attracted approximately $16 billion as a pure safety-first allocation.
Right, the flight to safety.
Exactly. The divergence here indicates that, in the immediate term, institutional allocators are trading Bitcoin as a high-beta technology proxy rather than an absolute safe haven. When geopolitical and macroeconomic friction peaks, traditional fiduciaries are still mechanically prioritizing legacy sovereign credit default swaps like gold.
And that tactical bleed makes a lot more sense when you look at the macro picture that dropped on our desks this morning. Let's look at the labor market, the resilience we thought we had. Completely shattered. Completely. Previous days demonstrated a highly resilient domestic labor force. Initial jobless claims were low, ADP private payrolls actually beat expectations, and the Federal Reserve was essentially paralyzed. They were mathematically unable to cut interest rates due to sustained domestic demand.
That paradigm was officially invalidated this morning. The new variable is the February non-farm payrolls print, and it registered as a massive systemic shock. The consensus forecast was projecting a 60,000 job expansion. Instead, the United States economy actively contracted by 92,000 jobs.
A contraction of 92,000 jobs.
Yes, and consequently, the national unemployment rate spiked to 4.4%.
But here's the part that really spins my head, and we need to look at this clinically. You've got this massive job loss, 92,000 jobs wiped out. But wage inflation remains remarkably sticky. Average hourly earnings actually rose by 0.4% month over month, bringing the average to $37.32. We're looking at a classic stagflationary paradox.
This specific combination, a contracting labor force coupled with sticky wage inflation, is structurally terrifying for traditional risk markets. The bond market immediately priced in the stagflationary reality, pushing the 10-year Treasury yield up to the 4.15 to 4.18% range. The Federal Reserve is now demonstrably trapped.
Because they can't cut rates to stimulate the collapsing labor market without further exacerbating that 0.4% monthly wage inflation.
Exactly. For the digital asset market, this forces an immediate reassessment of the fiscal dominance narrative. If the economy is contracting while inflation remains elevated, the central bank's models are functionally broken. They have no traditional monetary lever left to pull that doesn't cause severe collateral damage.
And we have to layer this domestic economic failure directly over the expanding international crisis. The geopolitical landscape shifted violently overnight. Yesterday, our baseline was that the United States and Israel had executed 2,000 precision strikes, successfully eradicating Iranian naval vessels. Operation Epic Fury was intense, but it was primarily contained to immediate maritime and military corridors in the Persian Gulf.
That containment has failed. The definitive geographic expansion of the theater of war is now a reality. Iranian-origin suicide drones have breached the South Caucasus. Specifically, they struck Azerbaijan's Nakhchivan exclave, targeting an airport terminal and exploding near a civilian school.
Which changes everything regionally.
It does. In response, Azerbaijani President Ilham Aliyev has ordered mobilization level number 1, which represents the highest state of combat readiness.
The fallout from this expansion directly threatens the global energy matrix. There is a severe systemic risk to the Baku-Tbilisi-Ceyhan oil pipeline. For context, this specific infrastructure corridor supplies approximately 1/3 of Israel's crude oil.
1/3.
Yes, so if this pipeline is disrupted by the localized mobilization, analyst project Brent Crude could immediately breach the $100 per barrel threshold. And for the Bitcoin ecosystem, oil at $100 a barrel acts as a direct, highly punitive tax on industrial computation and miner margins.
Concurrently, the political dimension of this conflict escalated significantly. In a recent Axios interview, President Trump declared that he will personally be involved in selecting Iran's next supreme leader following the death of Ayatollah Ali Khamenei.
He didn't mince words there.
No, he explicitly rejected Mojtaba Khamenei, calling him an unacceptable choice, and openly compared his planned intervention to the United States' influence over the government in Venezuela.
And just to pause here, to be absolutely clear for everyone listening, we are analyzing this strictly through the lens of market mechanics. We aren't taking political sides regarding the administration's foreign policy, the specific strategies employed, or the conflict itself.
Of course not. Purely structural analysis.
Exactly. Our only concern is how these geopolitical maneuvers impact institutional capital and asset valuation.
From a purely clinical perspective, the cost of this interventionist policy is the metric that matters most. Operation Epic Fury is currently estimated to cost the United States $891 million per day.
Nearly $1 billion a day.
Yes. To sustain a multi-carrier kinetic campaign at nearly $1 billion daily, while the domestic economy simultaneously sheds 92,000 jobs, the U.S. Treasury has no option but to aggressively issue new sovereign debt.
Which means eventually, the Federal Reserve will be forced to monetize this unbudgeted war debt. It creates a mathematical certainty of fiat debasement, reinforcing the core value proposition of non-sovereign bearer assets.
Precisely. The math does not allow for any other outcome.
Now, as this international pressure builds, let's pivot back to the domestic operational layer, because the infrastructure and regulatory war is heating up. Yesterday, the ecosystem had just secured a major victory. Kraken Financial was granted a Tier 3 Federal Reserve master account.
A huge step.
It's a massive deal because it provides direct Fedwire access. Simultaneously, we knew the Clarity Act was stalled in committee over the authorization of stablecoin yields.
But the legacy commercial banking system has just launched a highly coordinated counteroffensive against that infrastructure milestone. The Bank Policy Institute and the Independent Community Bankers of America formally condemned the Federal Reserve's approval of the Kraken account.
They're not letting this go quietly.
Not at all. They are officially accusing the Kansas City Fed of front-running the Federal Reserve Board's own public comment process regarding non-bank access.
The underlying threat driving this backlash is what analysts call deposit disintermediation, which is basically a clinical way of saying these legacy fractional reserve banks are terrified.
Absolutely terrified.
If a full reserve cryptographic entity like Kraken can settle dollars instantaneously directly with the central bank, everyday users and institutions will just bypass traditional correspondent banks altogether. The legacy monopolies risk massive liquidity drains.
And this institutional friction is directly mirroring the legislative deadlock in Washington. The Clarity Act officially missed its March worst drafting deadline. This stagnation is now compounded by a new proposed ethics ban.
Right, the ethics ban.
The amendment would explicitly prevent elected officials and their families from profiting from cryptocurrency ventures. Market analysts widely view this provision as a targeted maneuver against the World Liberty Financial Project.
This triggered a public escalation where Eric Trump openly accused J.P. Morgan Chase, Bank of America, and Wells Fargo of actively lobbying to protect their low-interest deposit monopolies at the expense of high-yield digital asset products. And again, we must clearly reiterate to you that this deep dive does not take a political stance on the proposed ethics ban, the Trump family's business ventures, or the traditional banking lobby.
Our focus is strictly on the capital flow implications.
Yes, we're simply presenting the structural gridlock that is actively holding back the deployment of institutional crypto liquidity.
That gridlock is a critical headwind, and it's forcing market participants to ruthlessly optimize their internal capital structures.
Which perfectly transitions us into the mining sector, because we are seeing a massive divergence in how operators are handling these compounding pressures. The squeeze on miners was well documented prior to today.
Collapsing hash prices and rising energy costs were taking their toll.
Yeah, we tracked mid-tier operators like LMFA liquidating their treasuries just to sustain daily operations, while corporate insiders at American Bitcoin Corp, or ABTC, were aggressively buying up their own depressed stock.
Today, the clinical data reveals exactly why those insiders were front-running the market. American Bitcoin Corp officially disclosed that their corporate treasury has reached a massive 6,500 Bitcoin, currently valued at approximately $470 million.
Unbelievable scale.
They achieved this by adding over 500 Bitcoin to their balance sheet in just the last 21 days. This aggressive acquisition establishes them as the 17th largest public holder globally. Furthermore, they just energized 11,298 new ASIC machines operating at an ultra-efficient 13.5 joules per terahash.
We can contrast that aggressive expansion with the data just released by BitFuFu. Their operational metrics show a deliberate drop in their managed hash rate, bringing it down to 26.4 exahashes per second.
A very different strategy.
Completely. However, they maintained a highly defensive posture. They retained a strong 1,830 Bitcoin treasury alongside $40 million in cash and stablecoins while actively paying down credit facilities.
The takeaway for you observing this capital allocation is clear. The era of raw, undisciplined hash rate expansion is entirely over. We have entered a strict regime defined by the survival of the efficient.
It's essentially a game of musical chairs, but the music just stopped, the chairs are on fire, and only the operators running ultra-efficient rigs like those 13.5 joule units have fireproof gear. The smaller miners are just going to get absorbed.
That is an apt analogy. Operators lacking sub-18 joules per terahash fleet efficiency, or those without massive unleveraged capital treasuries, will simply not survive. As that $100 per barrel oil threat materializes due to the expanding conflict in the Caucasus, smaller, inefficient miners will be crushed by operational expenditures.
The capital demands are just too high.
Exactly. The mega-cap entities optimizing their thermodynamics today will seamlessly absorb the market share of those forced to capitulate.
To summarize the intense convergence of data over the last 24 hours, we are tracking a critical technical test of the $70,000 structural floor, catalyzed by the sudden termination of ETF inflows. We have a domestic economy flashing severe stagflationary warnings following a 92,000 job contraction in the NFT print.
A massive shock to the baseline.
Internationally, an $891 million per day kinetic conflict has just expanded into the South Caucasus, directly threatening global energy supplies. And domestically, the legacy banking monopolies have launched a direct, coordinated assault against the integration of cryptographic infrastructure into the Federal Reserve System.
I will leave you with a final clinical question to ponder as we monitor these vectors over the coming days. If the United States domestic labor market is actively contracting, while unbudgeted war debt explodes by nearly $1 billion every single day, traditional commercial banks will be mathematically forced to offer even lower yields to maintain their own solvency.
Which creates a massive tension point.
It does. Under those deteriorating macroeconomic conditions, how long can the legacy financial system artificially suppress decentralized, high-yield stablecoin architectures before institutional fiduciaries simply route entirely around the Federal Reserve's perimeter to protect their capital?
That is the structural reality we are facing. Thank you for joining today's deep dive into the market intelligence. We will continue to track these developments clinically as the data unfolds.